Welcome to the Value Investor TV podcast. My name is Becco and my partner Hari.
Hello.
In this episode, we will talk about Carnival, specifically around management, valuation, things that we didn't talk about in the first episode. So if you didn't check out the first episode, go check that out before you come to this one. All right, Hari, give us a disclaimer to get started.
Yeah, this is the Value Investor TV podcast. We are the podcast that helps you grow your wealth and understand the concepts behind value investing. We are not a financial advisor. We don't know your specific financial situation. So if you're making any financial decisions, please consult with the particular advisor.
Fantastic.
All right. So we were talking about Carnival and how the business was a very capital intensive business. You have to buy boats. They're very expensive. That there's lots of risks associated with customers not wanting to come back because this is a luxury vacation for a lot of people, and that the economy is, the world economy is kind of getting hit hard right now. So certainly some things to consider there. But if we just look at the historical business, if when things start to settle down, what do you see as is this a business that is able to take the moat that we talked about, which we said was a brand-based and that there was high barriers to entry? Has that translated into a high return on capital and other types of profitability metrics?
Yeah. So, to answer that question, we usually look at various ratios to look at how capital are efficiently used, right? And if you guys want to kind of refresher on it, we recorded an episode on that. So go check that out. But, in this particular industry, right, this, as you talked about, Hari, this is a capital intensive business that usually takes on a lot of debt, which means that you have to look at ratios that takes that into account, right? So if you look at return on equity, for example, it doesn't really paint the full picture. It's a misleading indicator of capital efficiency. So what we want to look at here is either return on capital employed or return on invested capital. And I looked at return on invested capital here, and you're getting about 8%. About 8%, right? So since 2015 to 2019, return on invested capital has been roughly around 8%. So that's where you're looking at there, about 8%.
Okay, so an 8%, to be clear, is about the return you would get in the index. So an index fund is it has historically gotten you between 8 and 10%. So for a return on capital of 8%, we're not looking at a great return here, right? And I think that's worth noting because, that kind of highlights, is this a long-term business or is this more of a value play, right? And so, obviously we haven't even talked about valuation yet, but we would need to take into account the fact that this business doesn't grow very fast. So the things that we would really need to look out for are, how do they return their money back to their shareholders? And, how does that impact, or is the valuation cheap enough that we'll get a good deal if we were to buy this? Okay. Yeah. So moving on to the next part of our next section of our checklist around the financials. Does the company have enough cash to maintain its business? And I think of particular importance right now is if revenue is drying up and they're not able to run cruise ships for a month, 2 months, 3 months, do they have enough cash to keep the business going, to pay their employees, to maintain the ships while they're in dock, etc.?
Yeah. So maybe I can start with some ratios. So debt to equity ratio is about 45%. So debt to equity ratio about 45%. And you're talking about current ratio of about 22%. So those are kind of high level description of the current state of affairs in terms of the balance sheet. If you look at what is coming in terms of debt, So when do they have to pay the maturities of their debt? In 2020, so this year, they have $1.8 billion due this year. So, I mean, that is, that is something that is very noteworthy here, right? So, 1.8 billion due this year, 2021 next year, 1.9 billion due 2020, 2022, 1.3 billion due, so on and so forth. In total, long-term debt, debt about $11 billion.
And how much of that debt is covered right now just with cash on the balance sheet? How much do they have?
So cash on the balance sheet, straight up just cash, hard cash. You're talking about, again, this is before they drew out, they tapped into. So maybe taking a step back, they recently tapped into their credit facility, and they raised more cash to handle these short-term liquidity issues. Before that, what they had on the balance sheet in November 30th, 2019, they had about $500 million. Straight up cash, $500 million. And just to reiterate, 2020, they have $1.8 billion due.
Okay. So we saw that they have $11 billion in debt. That's what you mentioned was long term. What was the, so, to put this in perspective, how does that compare to their free cash flow? How much free cash flow do they generate? And is that, how long would it take them to pay off that debt with just their free cash flow prior to the coronavirus?
Yeah. So again, prior to the coronavirus, the kind of ratio that we like to look at is 3, right? So you must be able to pay off all of your debt with free cash flow within 3 years. So debt divided by free cash flow should be below 3 or equal to 3. That's what we're looking for. In this case, you're talking about 164 for 2019. In 2018, 4, 2017, 3, 2016, 4. So there was a huge spike in 2019 because there was a huge capex expense. So they took out basically money that came in from that cash flow from operation was about $5.5 billion. Capital expenditure was 5.4. So it really didn't have a lot left. So that's why it went through the roof. But overall, you're looking at around, if you kind of smooth the curve of this anomaly year of 2019, you're looking at around 4 to 3, right? It's more like 4.
So that 5.4 billion, that was unaffected by the cash flow, or unaffected by coronavirus. So with 5.4 billion in free cash, how much are they going to be able to pay off? They would have easily been able to pay off the 1.8 billion. But now it's looking like, we have to kind of get into how long is this thing going to kind of play out, and is that going to affect? So do you have any insight onto that right now? I guess a lot of people don't at this point, so it may be hard to judge.
Yeah, I think it's very hard to judge. It's so dynamic, this situation, right? The capex of 5.4. Now you're looking at, potentially delayed in delivery of the new boats that they ordered. Do they even want it now at this point? Like, there's a lot of moving parts right now. But kind of going back to your original question of, can they handle the debt load? I think it's a yes, especially given the fact that it is an asset-heavy business. They have credit facility that they tapped into. They can borrow against their existing asset base. By the way, if you look at their balance sheet, property, plant, equipment, $38 billion on their books. So that's accumulation of all of their assets, mostly boats, ships, $38 billion. So they could easily tap into that as a collateral. Just a side note that's been kind of interesting is that boats in the accounting rules, they depreciate all the way down to 15%, and 15% is the base, and they depreciate for 30 years. So
Do they
obviously with the balance, yeah, go ahead.
do they mention how old the fleet is?
Not by no. I don't think so. Not that I've seen. But one thing I do want to say about that is I was actually kind of surprised because I thought, cruise line industry, you buy a boat and then you kind of use the hell out of it. You just drain as much as possible, extract every ounce. But what I've seen in this company is that there is a lot of activity of buying new boats, selling old ones away, renovating. There's a lot of activity with their asset base.
Yeah, I guess it depends on how if the depreciation is straight.
It is linear.
Yeah, if it's a linear depreciation, that there may be a price point at which they may be able to sell the boat at a higher price point, get more value out of it, and then use that money to then, plus the depreciation expense that they're now that was allocated against earnings is now, is non-cash item. They go and buy a new boat, essentially. So,
Yeah.
Which makes sense. I mean, I think, when you're doing asset-heavy businesses, like you look at Southwest, they have very new fleets, and they tend to not run older planes because of fuel efficiency and lots of other factors. Where some of the other airlines are running older fleets and they have different, different lifespans on some of these aircraft, and so maintenance, parts, etc., may get more expensive as the boat gets older. You may have fewer part manufacturers for those parts, so the parts may get expensive. And then there may be expertise around maintaining the boat too that gets lost over time. So you kind of want to have a younger fleet. Plus, if you're taking a vacation, you don't want to be on an older boat, right? You want to be on the nice shiny new thing with Wi-Fi in every room and all that stuff, right? So you want to have the nicer amenities. So you may sell it to somebody when you can get a better price. And the interesting thing is, what is the market for this going to be for these giant expensive assets if they were to need to sell them to pay off the debt, or take more collateral? Is the bank going to value them the same, if they're not as useful, right? So
yeah, that's something that is important to consider, I think. Not because I do want to add that nuance to it. The fact that not all asset businesses are easy to borrow money against because of these outstanding issues, depending on the market. The current situation might not deem it as worthy as before, for example.
Right, and a bank may not want to. I mean, they own all these assets. They know what the value of these things are. Selling this asset, is maybe difficult for them to do, especially in this economy. So, loaning may be more of a problem. So, anyway, we'll move on to the next part of this, and the interesting thing that we talked about at the beginning of this episode was that this is a low return on capital business, right? So one of the things that we really want to find out before we even evaluate management, if at all do we need to even evaluate management, is what are they doing with the $5.4 billion in free cash flow? Are they doing share buybacks, or are they doing dividends in a timely fashion? When their stock price is expensive, are they buying back shares, or are they buying it when it's low, etc.?
Yeah. So from that perspective, if you look at their dividend payment, so let me just say this. So as you and I both know, that we like companies that does smart, timely stock purchase programs, right? We like that a lot as shareholders. We like companies that are purchasing their own stocks, in a timely, opportunistic fashion, instead of paying out dividend or buying stocks when the stock price is too high, right? Two alternatives we don't like. If you look at this company, if you look at amount of money that is returned to shareholders via dividend, is consistently higher than the amount of money that they use for stock buyback. So if you sum up the previous 10 years for dividend payment and 10 years of stock buyback, you are talking about $10 billion returned to shareholders through dividend payment and about 5.8, so $6 billion returned to shareholders via stock repurchase program.
So that's a total of how much? 15 billion?
About 15 billion for the past 10 years. That's the amount of money that we end up with. Yeah.
So 1.5 billion is essentially going to per year, roughly, and the other 3 to 4 billion is actually, I guess, going back into to buy new boats, to maintain boats, etc.
Yep.
Yeah, so that's the problem with the asset heavy business, right? Is that their cash flow is being spent on just maintaining their fleet, right? And that's always the fear, right? Is that this is a very capital intensive business, so you're going to see a lot of money being put back into the business instead of being sent away to shareholders. So far, nothing really strikes me about this business as a long-term play, right?
100%. I agree with you. For me, at least, like you want to look at obviously top line growth, bottom line growth, cash flow growth, and then also return on capital employed or return on invested capital efficiency ratios. All of those don't really check out.
Yeah, and so what we're really looking for here is, are they cheap on a valuation basis, significant enough to make this more like a one-time play rather than a buy and hold? Yep. So let's look at your valuation and let's get a number down, and then we'll see how that compares to the current stock price.
So one thing I do want to mention, so obviously discounted cash flow, you want to start with initial cash flow of the previous year. But because you had this outstanding year, not outstanding meaning like great, but kind of abnormal year in terms of capital expenditure, the free cash flow was kind of skewed. So I averaged out the past 3 years of free cash flow to set as the initial. Okay. So I did that. And here it is where it gets tricky, because as you guys all know, discounted cash flow depends heavily on growth rates that you assume, that you put into the calculus, right? So growth rate, the first 3 years, I said, again, my guess is as good as yours. I said negative 30%. And then next 4 to 6 years, it comes back to about 5%, which is what they said, right? That's the kind of the growth of the entire industry, about 5%, 5 to 6%, and then tailing down to about 3% on year 7 to 10. And then, as usual, we use discount rate of 10%. And if you do the discounted cash flow analysis, you get about 6.37. Right now, at the time of this recording, the share price is trading at around $8.50. And we got 6.7, about 7. Again, I just want to highlight this once more. This heavily depends on the assumptions, right? The growth rate that we put into the calculation. The first 1 to 3 years, I said negative 30%. It could be high, it could be low. I don't know, but just kind of that's what I put into the calculation. It's hard to tell with the coronavirus at this point, right?
Yeah, I think one thing that is interesting about this, and I think is a lot of people will probably come to this business because of the price to earnings ratio or some other factor that's very, very cheap, right? The price to earnings right now, obviously this is based on their trailing price to earnings. The PE ratio is like 3, a little above 3, right? Which is insanely cheap. And their dividend is around 24% or so. They're paying about $2 a share in dividends. So, if you were to buy this and then just collect cash forever from this business, you could potentially get 24% yield, assuming that they're able to maintain that dividend, right? So there is certainly something very interesting about that concept, right? So, you said that they are paying out about $1 billion in dividends right now. And if that $1.8 billion comes due, would they have to suspend the dividend or potentially cancel it for a year, or permanently, just to pay off, the 1.8, and then they would resume the dividend in the future, right? And at that point, we bought it at such a cheap price that our, because we always talk about free cash flow. Cash flow makes a lot of sense for a lot of ongoing businesses, right? But you're looking at a business that is trading, that has been able to generate almost $3 a share in earnings, right? And it, has traded as high as $50 a share in the last year, or in the last 12 months. So when you look at it from that perspective, it certainly looks cheap, right? And I would argue that $51 a share is way too expensive for this company, right? But $15 or $20 a share is not unreasonable or even $25 a share is not unreasonable for a slow growing, business. And what we're paying right now is a third of that, right? So from that perspective, there is a significant margin of safety, right? And then when you look at it, that they have $5.8 billion is their market cap, but their balance sheet has a enormous, they have $38 billion in assets. They obviously have a lot of debt there too, right? But from a price to book ratio, how do you see that as being that is pretty cheap also?
Yeah,
right?
let's take a look. So equity about $25 billion, right? Just straight up.
Yeah, and
yeah, go ahead.
Yeah, and so the price to book is around 2.2, 0.3, somewhere in that range, right? So that is a significant discount to, and if you're, so our real concern is, right, if we look at this as, let's forget 2020, let's say they have a huge loss, whatever, right? In 2021, right, things start to pick up, they recover. Maybe they're not quite back to 2019 earnings, right? But I would imagine that the stock price would be cheap enough today to warrant, let's say, $1 in earnings next year, right? If we modeled that as our scenario, right, and I'm using this number not scientifically, I'm just saying a number. If we assume that it'll take a full year to recover, and by summer 2021 the business starts picking up, right, which is their heavy season, it's potentially, this is a very, very cheap business, right, from that perspective. So our real concern here has nothing to do with anything other than, can they pay off the debt that is going to be coming due this year and next, right? I mean, do you think that first of all, is that a reasonable thesis, right? Can they pay off the debt? Is that what we should only be focused on, or is there going to be long-term headwinds in the cruise ship industry going for the next 5 years?
Oh man, I think those two questions are both important to answer. So in a very short term, this year and next year, are they able to survive? And I think to that question, I would say yes. I would say pretty confidently yes, they would be able to survive that storm. On the second point of kind of in the intermediate term, within the next 5 years, will their business be able to bounce back up to where it is today, or potentially a little bit lower, but still bounce back up today? I think yes. I think yes. So I think those two questions are both important for our discussion.
Okay, so going into that, we think that they'll survive. They'll be able to cover this upcoming debt, and that they may be able to cut some of their maintenance expenditures, move things around. Maybe it'll make it work. For next year, they'll probably still have some free cash flow this year, even though, but it'll probably be a big hit to their business. So the real question that I have is, if they can survive for a whole year, right? because at this point the business is being priced as if they're going into bankruptcy. So we need to find out if indeed that they would go into bankruptcy, which I don't think is going to happen, right? As we've talked about, they have enough assets to pay things down. They could sell enough boats to pay $1.8 billion, right? And you said that they've drawn down how much off of their credit facility? So
About, let me just double check so I don't give you the wrong number. Give me 1 second.
yeah, so the idea here is that we're going to take the credit facility plus the $500 million that they had on cash, then the potential that they have $25 billion in equity that they could pay some amount down, right? So to recover cash and then pay 1.8 billion, right? So in a disaster scenario, they'd still be able to pay down their debts, right? So so how much did they pull down on the credit?
So
facility?
they have. So it doesn't. So my note doesn't say whether they actually pull down on the credit facility, but they have available through their line $3 billion. Okay, so they have $3 billion ready to deploy, ready to pull whenever they want. And that expires in 2024. So the facility is available until 2024.
Okay, so if they haven't drawn it down, they may be okay. Right? Their thought process may be we don't even need to draw down on it.
Potentially. I haven't looked at current use. Most of my analysis was just done through the SEC filings. Previous year SEC filings. I'm not sure if they have currently.
Okay. So yeah, what we are kind of looking at right now is almost a, this is an asset play. This is a cheap based on metrics that are their ability to generate earnings is much higher than their current price, right? Relative to their current price. So you are buying a business that you could essentially get dividend payments for, to pay you back. They haven't announced anything about suspending the dividend. So there's a potential here for a very high rate of return just by holding the stock, right? And then, getting a dividend forever. So we would have to also consider, would they need to suspend the dividend? Long term, typically companies don't suspend and restart. They cancel it altogether and then have no plans to restart it until they make another announcement. But a business like this, which is not generating a whole lot of growth, is going to return cash back to their shareholders somehow, right? And you would also think if business management were savvy, if the stock price stays as low as it is in a year or 2 or 3, that they would also go back and say, buy back their shares, right? So there's definitely ways that they can boost the share price and pay us back with dividends because the price is so low right now.
I would say maybe one data point that could help us answer that question regarding the dividend payment, at least, is if we look at 2018 number, 2018, not 2018, 2008, 2009 numbers. The dividend payment at 2017 before shit hit the fan was about $1 billion, and then it came crashing down, and they never suspended it. It was hovering at around $300 to $200 million in dividend payment still. But they did, interestingly enough, raise a little bit money by increasing their share count. So floating a little bit more money. Their share out in the open market, they raised about 8 million, 12 million. And to answer your question about dividend payments, they have ever since 2000 or 1995, dividend payment never stopped.
So I mean, that's good evidence that they would probably continue it. They may cut it in half, or they may lower it. Because their outlay for dividends is pretty high, right?
Yeah.
They probably have $1.5 billion is how much they're paying out. So let's say that even then they cut it in half, you're still getting a 12% return.
Yeah.
Right. If they cut it by
Yeah, I would say they might cut it much more drastically. If just looking back into the history, right? So 2018, it was around or 2008. I keep saying 2018. 2008, about $1 billion in dividend payment. They chopped it by a third, and even more by one fourth, one third, one fourth. So I imagine they would kind of do something quite similar here. Dividend payment was 1.4 last year. So if they slash it by, I don't know, fifth this time or sixth, you know, that could be totally within the realm of possibilities.
So let's say that they cut it by 75%. You know, it drops down to 50 cents a share from $2 a share. Even in that scenario, you're still getting a 6.5% dividend payment, let alone the share price. And then if the dividend returns to its former glory, you know, in the future, you're still going to get a very high rate of return, right? So those kind of deals, you know, often only come when there's a big recession, there's a big, you know, hit, right? So the real question for all of us is, are they going to be able to survive, you know, out and stay out of bankruptcy, right? And I think we both feel comfortable that even in the financial crisis, right? I think that the interesting thing about the coronavirus is not, you know, the financial crisis affected all spectrums of business, you know, all socioeconomic spectrums. The unfortunate thing about this is that the coronavirus is having a heavy impact on hourly workers, laborers that are working in retail, workers that are blue collar workers who can't work from home. You know, they have to go into a factory, they have to go in. And although those people are going to Carnival, you know, on their lower tier services, the higher tier is not going to be as affected by this, right? People who are able to, you know, work from home, they're not impacted by this. So they're going to definitely take a hit. But it'll be interesting to see how their luxury business maintains itself. I'm sure it will take a hit too, but it may not be as big as, you know, the lower tier groups. So, so I think there's a lot of interesting stuff here to talk about, right? And I think the main thing that we, you know, as value investors are looking for is, this is not a long-term play, but at this price point, there, I think, is a significant margin of safety built into their asset base, right? That allows us to, you know, to collateralize their assets if they need cash to pay any of their debts down, right? They could conceivably sell their entire fleet today, pay off their loans, and have another $12 billion to disperse to shareholders, right? So there's a significant margin of safety from that perspective, that I think that they would be able to survive through this, even if the coronavirus stretches through the summer, right? Which I think we're not expecting it to do that. So
yeah, it's definitely very different play, right? Very, very different play than what we're used to, what we like. For me personally, you know, I like businesses that are excellent businesses. Even if I have to pay a little bit more, I like to own those things. This is a totally different play. And, you know, even within kind of the cigar butt type of model, you know, you're looking at kind of a slightly different angle, looking at dividend payments as a way to extract value out of this company, in addition to stock price elevation in the future.
Yeah. All right. Well, I think we've covered this one. You know, if you would like to talk about Carnival Cruise Lines with Becca or myself or anybody else on the Slack channel, you can send us an email, info@valueinvestor.org, and we can invite you. And if you want to look at our checklist, send us that email to info@valueinvestor.org. We're happy to share it with you. And you know, we're very excited to, you know, keep this going, have conversations with people, share as much of our knowledge as we can. And, you know, these are interesting times for everybody. You know, stay safe, but if you're you've got some extra money to spend, this is a good time to look at the market and find good deals. So come learn from us, and we have a nice long backlog of things at this point to explain the basics as well as get you up to speed and think about companies. So send us an email if you'd like to get those checklists, or on the Slack channel, but then go back and episodes 1 through about 30 or so have a lot of the basics of value investing covered. So all right, anything else to add, Becco?
No, definitely. It was interesting. Thank you so much for sending us this request. Good opportunity for me to look into this cruise line industry, and specifically Carnival. It's great. So keep that coming.
All right, guys. Thanks a lot. And we'll talk to you later.
Thank you.